All right, if you care about markets at all, stop scrolling for a second and stay with me here, because something just happened in the last 24 hours that most people are going to completely misunderstand. Silver didn't just drop, it collapsed. We're talking more than 21% in a single session, falling from roughly $120 an ounce down to about $97. And in the process, somewhere between 1.4 and 1.5 trillion dollars in market value just vanished. Not over months, not over weeks, in one day. Now here's the part that should immediately grab your attention. This didn't happen because demand disappeared. In fact, physical silver prices in China barely moved. Shanghai premiums stayed elevated. The futures market and the physical market just confirmed the same thing at the same time. This was a paper market event, a leverage event. And if you stick with me for the next few minutes, I'm going to show you exactly how to recognize these moments before the headlines even catch up. If you're holding silver right now, if you're watching this market, if you've been stacking physical, you need to understand what you're actually seeing. Before I explain what caused this move, let me teach you something that most people never really internalize about how markets actually work. Price doesn't always move because the fundamentals changed. Sometimes, and this is critical, price moves because positioning broke. Think of markets like a crowded theater. Everything's fine. People are sitting, watching, relaxed. Then someone trips near the exit. Nothing about the building changed. The roof didn't catch fire. The structure's perfectly safe. But suddenly everyone rushes the same door. That's what leverage does to markets. It creates a situation where price stops reflecting value and starts reflecting forced behavior. Panic selling, margin calls, liquidations. Most people look at a crash like this, and their first question is, what bad news came out? But the better question, the question that actually helps you understand what's happening, is this. Who was overextended, and where were they forced to sell? Once you learn to ask that second question, you start seeing these moves very differently. You stop reacting emotionally and start watching mechanically. And that shift in perspective, that's worth everything. So, if this is making sense so far, drop a comment below and let me know what you're thinking, because we're just getting started. Now here's what's actually happening with silver, step by step. And this is where it gets really important. Silver didn't just drift higher over the past few months. It went parabolic. When price accelerates like that, when you get that kind of vertical move, leverage absolutely piles in. Futures traders start adding contracts. Funds press their positions harder. Margins look totally manageable as long as price keeps rising. Everyone's making money. Everyone feels smart. Then something shifts. Liquidity thins. That's the key moment. When fewer buyers are left at the margin, even a small downtick can hit margin thresholds. So when silver slipped, just a little at first, margin calls started firing. And when margin calls fire, you get forced selling. That forced selling that pushes price lower. Lower prices trigger more margin calls. More margin calls cause more forced selling. That's the cascade. It feeds on itself like a chain reaction. And here's what's wild about this whole thing. None of this requires anyone to actually change their mind about silver long term. It's mechanical. It's automatic. It's like a domino chain once the first one falls. The dominoes don't decide to fall. They just do. Now let me add another layer to this because it's important. When futures contracts get too crowded on one side, when everyone's positioned the same way, you create what's called a liquidity vacuum. That means there aren't enough natural buyers on the other side to absorb selling pressure without price moving violently. So you get these air pockets, price just drops through levels that should have been support because there's nobody there. The buyers who would normally step in at 115s or 110 or 150, they're already in. They're already long. They can't provide liquidity because they're part of the problem. They're holding positions that are now underwater, wondering if they should cut losses. This is why leverage kills. It's not just about being wrong on direction. It's about being right on direction, but wrong on timing, and getting forced out before the move you expected actually happens. But here's the part that should make you pay very close attention. While COMEX futures were getting absolutely smashed, physical silver in China stayed tight. Shanghai premiums didn't collapse. They stayed well above 20% in some cases. That divergence matters enormously. See, futures prices reflect leverage and liquidity conditions. Physical prices reflect actual supply and demand from people who want the metal. When those two split like this, when you see that gap widen, it's telling you something very specific. The selling pressure isn't coming from end users walking away. It's not coming from industrial buyers saying, "We don't need silver anymore." It's coming from paper positions being liquidated under financial stress. That's a fundamentally different signal than a true demand collapse. And you absolutely need to know the difference because it changes how you should be thinking about what comes next. This is the exact same playbook that silver has followed multiple times before. Go back to 2008. Silver got obliterated during the liquidity crisis. It dropped from around $20 down to $9 in a matter of months. But it wasn't because people stopped wanting silver. It was because everything leveraged, everything that could be sold to raise cash, had to be sold. Banks needed liquidity. Funds needed to meet redemptions. Margin calls were system-wide. Then look at 2011, after that massive blow-off top when silver hit nearly $50. The correction that followed was brutal. Silver lost more than 40% in a few weeks. Same mechanics. Leverage unwind, forced selling. Or go to March 2020, when silver crashed alongside literally everything else during that global margin scramble. It went from $18 down to $12 in about 2 weeks. And what happened next? Once the forced selling exhausted itself, once the leverage was flushed out of the system, price stabilized and the larger trend reasserted itself. Every single time this pattern appears, you see the same sequence: violent drop, emotional headlines everywhere, claims that the bull market is over or the story has changed. And then, once the leverage is actually cleared, once the weak hands are shaken out, price finds a bottom and moves forward. If you zoom out and look at the bigger picture, these events tend to mark inflection points, not endings. Now, let me be skeptical for a moment, because that's how you stay honest in markets, and I want you to hear independent thinking here, not just hype. Could this turn into something worse? Absolutely. If liquidity across the entire financial system keeps tightening, if we get some kind of broader deleveraging event, silver's not going to be immune. It'll get sold with everything else. Could there be manipulation? People always ask that question. And here's the thing. Arguing about intent doesn't help you trade or invest. It doesn't help you make decisions. What matters is structure. What matters is understanding how the machinery works. Focus on what you can actually measure. Focus on positioning data, on spreads between markets, on physical premiums, on observed behavior. Markets don't need villains to break. They just need leverage and thin liquidity. That's enough. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. Maybe you're short-term focused. You're staring at the chart, watching every tick, wondering if you just witnessed the top. If that's you, your job right now is patience. Let the forced selling finish. Don't try to catch the falling knife. Watch for actual stabilization, not just bounces. I'm talking about price consolidating between $95 and $100, with volatility starting to contract. That matters way more than trying to make hero calls at the bottom. Wait for confirmation. Maybe you're longer-term oriented and you've been bullish on silver for months or even years, and this move just rattled you. That's completely normal. Nobody likes watching 20% evaporate in a day. For you, the question isn't what the price is today. The question is whether the physical tightness that drove this move in the first place is actually easing, and so far it isn't. Shanghai premiums are still elevated. The disconnect between paper and physical is still there. That tells you something. And maybe you're brand new to this. You're trying to make sense of how something can crash this hard without any fundamental collapse in the underlying story. If that's you, this is your lesson in leverage. Learn it now. Internalize it. Understand that markets can move violently based purely on positioning, not fundamentals. It'll save you a lot of pain later. No matter which of those 3 categories you fall into, the universal principle is this: understand the mechanism before you react to the price. Don't let emotion drive your decisions. Let structure and data inform your thinking. So here's what I want you to answer in the comments. Which of those 3 are you? Are you short-term and waiting, long-term and holding, or new and trying to learn? Let me know, because understanding where you are mentally helps you make better decisions about what to do next. Now, let me tell you where I personally stand on this, because I think transparency matters. I'm not panicking, but I'm also not blindly buying the dip, like this is some automatic opportunity. I'm watching. First, I'm watching that $95 to $100 zone for real stabilization, not just bounces where price comes back for a few hours and then rolls over again. I'm looking for reduced volatility, for the wild swings to calm down, for price to actually settle into a range. If that happens, it signals that the forced selling is done. Second, I'm watching Shanghai premiums closely. If they stay above 20%, if that physical tightness persists, that's a loud signal that the underlying demand story hasn't changed. It tells me this was a paper market problem, not a real-world problem. Third, I'm monitoring open interest in the futures market to see if leverage is actually being flushed out. I want to see those numbers come down meaningfully, because that's what confirms the deleveraging process is happening. Based on everything I'm seeing, this move was mechanical, not emotional. It was structural, not random. The fundamentals that drove silver higher in the first place, the supply constraints, the industrial demand from solar and electronics, the monetary uncertainty that makes people want hard assets, none of that broke. What broke was positioning. What broke was leverage. And historically, when silver goes through a leverage flush like this, when you get this kind of violent shakeout, it tends to set the stage for repricing once the forced selling actually ends. I'm not making a prediction here. I'm not telling you silver is going to $150 or back to $80. I'm telling you to watch the data and understand what the signals are actually saying. If you made it this far, you're part of a very small group of people who are willing to think critically instead of just reacting emotionally. That mentality, that willingness to dig deeper and understand the machinery, that's what separates people who survive these markets from people who get destroyed by them. So, do me a favor. If this breakdown helped you see this situation more clearly, hit that subscribe button and share this with someone else who's trying to make sense of what just happened. The vast majority of people are going to read a headline that says, "Silver crashes 21%, and think the story's over. You know better now. You understand that leverage events create opportunity as often as they create risk, but only if you know how to read them. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Make your own decisions based on your own situation and risk tolerance. But whatever you do, stay sharp out there. Think critically, watch the signals, and don't let headlines think for you.